Mike Willis, CEO of Hornet ETFs. Your firm has a fund that combines tracking the S&P 500 and Bitcoin. Can you tell us about the fund?
Sure. We put 75% in the S&P 500 constituents, so we own all 500 plus companies. Then we layer in 25% crypto holding. In the case of BBB, it's 25% Bitcoin exposure. And then we rebalance monthly. So the methodology basically takes the champion of TradFi and the champion of DeFi, and our mission is to bridge TradFi to DeFi using SEC regulated ETFs. So we came up with the 75-25 methodology because the 25% we feel gives the investor enough exposure to the crypto asset to where if it does what we think it's going to do, and go up for the next 5 or 10 years, then they're going to get great exposure to it. If, on the other hand, the worst case happens and it goes to zero, they still potentially have 75% in the number one index on Wall Street. So, in our opinion, it's a win-win either way.
Now, why might this be of benefit for financial advisors and their clients?
Sure. I think advisors are risk averse from a volatility standpoint because they really don't want their clients calling them every time one of their positions is up or down 20% in a week, which happens often with crypto. And Bitcoin, especially in the last 2 months, has gone down by 40%. That would generate phone calls to advisors. Advisors don't want those calls. They don't want their clients to feel stress. So when their clients look at their statements and they see a position down 30% or down 40%, advisors try to avoid that. So number one, they want to minimize the stress for their clients by burying the crypto holding into a 75% S&P 500 weighting. You really do smooth out the ride for that client. It will generate less calls to the advisor, and from a fiduciary standpoint, it protects the advisor because, frankly, if they put them into a 100% Bitcoin ETF like the BlackRock one, which is the leading one, let's just say Bitcoin goes down 50%, the client calls in and says, "Sell me out. I don't like this." That's a potential fiduciary liability to the broker. The last reason is we believe the crypto exposure is going to perform really well over the next decade. We think we're early into the digital assets coming onto the scene as a new asset class on Wall Street. So we want these clients to gain the exposure to the crypto growth. So the way to do that, really many investors may think they can handle the volatility of a new asset classes, but in reality, people sell out when the volatility is going down, and when it's going up, they get excited and they buy, and that's how you lose money. So it's like a bar of soap. The more you touch it, the smaller it gets. So as an advisor, they win in a number of ways. One, they have a digital asset plan for their clients, which they need to have because their clients are buying crypto around them and they don't want to be bypassed as a dinosaur. So they have a plan, a digital asset plan that makes the advisor look forward thinking. Number two, they allow their clients a smart way to gain exposure to crypto while their ride is smooth. And number three, it protects their fiduciary liability. So those are the three main reasons.
And finally, what would you say to financial advisors and even individual investors who are still skeptical of crypto, even Bitcoin?
Yeah, I think part of that is when the internet came on the scene. I don't know how many people remember that, but there was a lot of talk about the internet was for criminals, it was for pornography, all the normal suspects. And until it became mainstream, then all of a sudden, people saw, how beneficial the internet was. But it took people a while to warm up to it because the initial FUD about it was so negative. The same thing happened with crypto. I think because Bitcoin is better engineered currency than the US dollar, in my opinion, and a lot of other people's opinions. I think there was resistance within the system to embrace Bitcoin like it was embraced in the retail sector. And this was the first time, Chris, that Main Street had an investment product before Wall Street actually did. And the retail investors got in before the institutional investors got in. It's normally flipped on Wall Street. The retailers get the scraps. But in this case, retail was first into Bitcoin. I think a lot of the FUD out there that was spread about Bitcoin was that it was criminal money, it was pornography money, it was for anonymous purchases that nobody wanted to track. When in reality, this is what I would say to people. Bitcoin is not anonymous money. In fact, it's a permanent digital ledger. Every 10 minutes, every transaction that was done in Bitcoin is minted in a block permanently that cannot be changed. And so that permanent digital ledger is accountability. And so I think institutions, after 17 years of watching Bitcoin, realize that the benefits are such that they've changed their minds, and the same companies that were against it 5 years ago are now promoting it, and we're seeing more and more adoption every week, new announcements from new institutions. So what I would say to those that are still on the fence is spend a little bit of time doing a little bit of research on it, and I think you'll get more comfortable with the technology, why everybody's so excited about it. And in a methodology like we're using, we can help bridge these investors into the new digital asset space in what we think is a smart and safer way.
Mike, thank you very much for your time.
Thank you, Chris. Great to be here.